Welcome back to the deep dive. This is where we, try to make sense of the really challenging bits of financial reporting. Make it clear, make it usable. And today, we're diving into uncertainty. Probably the biggest conceptual headache in financial accounting, wouldn't you say?
Oh, absolutely.
Our mission today is tackling International Accounting Standard 37, IAS 37. That's provisions, contingent liabilities, and contingent assets. And look, this isn't just about your debits and credits. This standard, it's a real test of professional judgment for anyone facing the financial reporting exam.
That's spot on. I mean, think about it. Every successful company, it operates knowing future costs are coming, right?
Right.
Maybe lawsuits, maybe environmental cleanups, maybe warranty repairs. But the when and the how much,
Yeah.
that's uncertain.
Yeah.
And the whole point of IAS 37 is figuring out when that potential problem firms up enough. When does it become solid enough to actually put it on the balance sheet as a liability? Because that hits your reported profits, your financial position.
And the consequences of getting it wrong are huge, aren't they? We've seen companies collapse, massive restatements, all because they didn't properly account for things like product recalls or big legal cases.
Definitely. Getting this wrong isn't just about losing marks in an exam. It fundamentally misrepresents how healthy a business actually is.
It goes right to the quality of the earnings, doesn't it?
It really does. If you skip recognizing a provision you should have, well, you're basically overstating your profits and understating your debts. IAS 37 is the filter, the rule book, that makes sure we stick to those core principles like faithful representation and prudence.
Okay, so for you listening, whether you're deep in exam prep or you just want to get smart about understanding corporate risk, our aim today is simple. We want to map out that whole spectrum of certainty. By the time we're done, you should have a really clear decision path. For any scenario, you'll know. Do I recognize this liability? Do I just disclose it in the notes? Or actually, do I ignore it?
And that decision, it all hangs on judging the probability and whether there's a real unavoidable obligation.
Right then. Let's start at the top. Provisions. These are the ones that have to land on the statement of financial position, the balance sheet items. What are the three absolute must-haves, the criteria that all have to be met?
Okay, so provisions. Fundamentally, they're liabilities, but liabilities where the timing or the exact amount is uncertain. That's what makes them different from, say, your regular trade payables or accruals where you pretty much know the details. Now, for something to be a provision under IAS 37, you absolutely must meet all three recognition criteria, no exceptions, if even one fails.
Just one.
Just one. If one fails, IAS 37 is very clear. It is not a provision. And then we have to start thinking about contingent liabilities instead.
Okay, let's unpack number one. This feels like the big conceptual hurdle sometimes.
It often is. It's the requirement for a present obligation as a result of a past event. This is really the foundation. The obligation, the liability, it has to exist right now at your reporting date. And it has to be there because of something that's already happened in the past.
A past event.
Yes. And crucially, that past event must be what we call an obligating event. It has to lock the entity in.
So how do we draw the line between, a cost that might happen in the future versus something that's a present obligation now?
Good question. A present obligation means the company basically has no realistic way out. They have to settle it. If the company could still avoid the cost just by changing its future plans, like deciding not to shut down a factory before they've actually announced it and committed to redundancy payments, then there's no present obligation yet.
Okay.
The trigger event has to be in the past, and it has to be, well, sort of irreversible from the entity standpoint regarding the cost.
And when we talk obligation, there are two flavors, aren't there? The straightforward one and the one examiners seem to love testing.
Exactly. The straightforward one is the legal obligation. This comes from things like a signed contract, a law passed by government, or maybe a court judgment against the company. If a court says you infringed a patent and have to pay damages, boom, that's a legal obligation. Pretty clear cut.
Makes sense.
The slipperier one is the constructive obligation. Now, this arises differently. It comes from the company's own actions. Maybe they have a long-standing pattern of behavior, or they've published specific policies or made a very public, very specific statement about accepting certain responsibilities.
So it's based on behavior and statements.
Yes. And the key is that this action must create a valid expectation in other people's minds, customers, employees, the public, an expectation that the company will follow through on those responsibilities.
That's interesting, the constructive part. It relies on reputation, what people expect, not just a piece of paper like a contract. What stops a company just saying, oh, that was just us being nice. It was a moral thing, not a real obligation.
That's precisely where the judgment comes in and where auditors really dig deep. The difference between just being nice or moral and having a constructive obligation boils down to unavoidability. Is it realistically avoidable? Think about a retailer with a very well-known, publicly advertised 90-day, no questions asked returns policy. Maybe the law only requires 30 days, but by consistently advertising and honoring the 90 days, they've created a constructive obligation. Customers expect it.
Right.
Now, could the company change the policy tomorrow for future sales? Yes. But for all the sales they've already made under that 90-day promise, that obligation is present. It's unavoidable for that batch of sales.
Ah, I see. So the past event is the sale itself, and the public policy creates the unavoidable future cost, the return or repair for those specific past sales.
You've got it. This criterion makes sure we're not creating provisions just for, general corporate goodwill or potential future plans. It has to be tied to commitments that have already happened and lock the company into a probable cost.
Okay, that nails down the first criterion. Let's move to number 2. This is about the likelihood, isn't it? The chances of the cost actually materializing.
Yes. Criterion 2 is the probable transfer or outflow of economic benefit. And here, the word probable is absolutely critical. It's probably the single most important definition in IAS 37, and it's interpreted quite strictly.
And how does this standard define probable? Is there a number?
There is. It means the likelihood of the outflow happening is greater than 50%. More likely than not. Simple as that.
Okay.
If you assess a potential future payment and figure it's 51% likely to happen, it's probable. You meet this criterion and you move on to the next step for provisioning. If it's, say, 49% likely, or even 50%, it fails the probable test.
So 50% isn't enough.
No, it has to be more likely than not, greater than 50%.
Yeah.
If it's 50% or less, you stop thinking about recognizing a provision and start thinking about contingent liability disclosure instead. That 50% dividing line is absolute.
That clarity is vital. So when you're reading an exam scenario, you're immediately hunting for that probability percentage.
Absolutely. And the third criterion, this one deals with the money side, a reliable estimate of the amount. Now, IAS 37 acknowledges we're dealing with uncertainty, right? So you don't need a perfectly precise to-the-penny figure, but you do need to be able to measure the obligation with sufficient reliability.
So there's an element of judgment here, too, about what reliable means.
Yes, definitely. But it means you need a reasonable basis for the number. Now, imagine a situation, and this is rare, where a company clearly has a present obligation, criterion 1 met, and the outflow is definitely probable, criterion 2 met, but they genuinely cannot estimate the cost. Maybe it's a completely unprecedented event, massive scale, no history. The range of possible outcomes is just gigantic, making any single best estimate pretty meaningless.
Okay.
In that very rare circumstance, even though the obligation is present and probable, you cannot recognize the provision because you can't measure it reliably. It defaults back to being treated as a contingent liability, needing disclosure in the notes, but not recognition on the balance sheet.
Got it. Okay, let's pull these 3 threads together with a classic example. The G-Star warranty scenario from the materials.
Right. G-Star sells products with a 1-year warranty. They look at their past data, and it shows that about 5% of all their sales end up needing a warranty repair. Let's run it through the 3 tests.
Okay. 1, present obligation.
Yes. The sale itself is the past event. The warranty promise, whether it's legally required or just their stated policy, is attached to that sale, creating an obligation.
2, probable outflow.
Yes. Now, you might think, hold on, 95% of customers don't claim. But G-Star isn't looking at one customer. They're looking at a huge population of sales. The statistics give them high certainty that across that whole group of sales already made, warranty costs will be incurred. The outflow is probable for the group.
Okay, makes sense for the population. And 3, reliable estimate.
Yes, they have the 5% claim rate data, and presumably they know their average repair costs from history. That allows them to calculate a reliable estimate of the expected financial cost for all the sales made in the period.
So all 3 criteria met.
All 3 met. The conclusion for G-Star is clear. They must create a provision for those expected warranty costs. That liability goes onto the statement of financial position. Then, as customers actually make claims over the next year, the provision is used up or reduced.
Right, so we've decided, yes, at the provision, we've jumped those 3 hurdles. The next challenge, and this can get quite technical, is figuring out the amount. How much do we actually recognize? We know it has to be the best estimate, but IAS 37 says the calculation method depends on what sort of obligation it is.
That's a really critical distinction for you to grasp. You can't just use one calculation method for everything. A one-off, unique situation needs a different approach than dealing with, say, thousands of identical small warranty claims.
Okay, let's start with those unique events, the big, unusual stuff.
Right, that's A. Best estimate for a single obligation. The rule here is pretty straightforward. You use the most likely outcome. When you're facing a single specific event, like one major lawsuit that could settle in maybe 3 different ways, or cleaning up one particular contaminated industrial site, the estimate that best reflects the likely outflow is simply the single outcome that has the highest individual chance of happening.
The logic being you don't get to average it out over lots of events, so you have to kind of bet on the single most probable result.
That's exactly the intuition. Let's take that North Sea oil rig explosion example again. The lawyers look at the legal claim and say, okay, there are 3 possibilities. We might settle for $25 million, and they think there's a 20% chance of that. Or we might settle for $40 million, and they put a 45% probability on that. Or worst case, it could be $65 million with a 35% chance.
Okay, so the probabilities are 20%, 45%, 35%. Now, if you just did a straight probability weighted average, the expected value, what would that give? Let's see, 0.2285 plus 0.4540 plus 0.3565. That's 5 plus 18 plus 22.75 equals $45.75 million. Sorry, I think the example in the notes calculated as 43 mm. Let me check. 0.25 is 5M, 0.4540M is 18M, 0.3565M is 22.75M. Ah, yes, 5 plus 18 plus 22.75 is indeed $45.75. The outline said 43M, and perhaps the source had slightly different numbers.
It seems there might be a slight discrepancy in the source calculation, but the principle is the key thing. Even if the expected value calculation came out at, say, $45.75 million, IAS 37 says don't use that expected value for a single one-off event like this major lawsuit.
Right.
Because it's a single event, you must provide for the individual most likely outcome. Which outcome has the highest probability?
The $40 million settlement at 45% probability.
Exactly. So the provision recognized must be $40 million, not the $45.75 million average. This rule forces the provision to reflect the single most probable scenario for that unique event.
Okay, clear distinction. Now let's flip to the other situation. Not one big event, but loads of similar, smaller ones, like those warranties we talked about.
Right. That brings us to be expected value for a large population. Now, when your obligation relates to a big group of similar items, thousands of warranties, maybe common product defects across a batch, the math actually works out that the expected value, the probability-weighted average, becomes the best and most reliable estimate of the total outflow.
Because the probabilities get a chance to play out over the large number.
Precisely. It averages out. The expected value method gives the most accurate prediction of the overall cost for the whole group.
Can you walk us through the numbers for that secondhand car warranty example?
Sure. Let's say a dealership sells loads of used cars with warranties. They look at their data. 80% of cars sold need 0 repairs, so $0 cost. 15% need minor repairs, and the total cost for all those minor repairs comes to $100,000. And the remaining 5% need major repairs, costing a total of $500,000 for all those major repairs. To get the provision amount, we calculate the expected value, often shown as E. You sum up each outcome's probability multiplied by its cost. So E, prob 1 cost 1, plus prob 2 cost 2, plus prob 3 cost 3.
Which in this case is 80 per $100 plus 15% $100,000 plus $500,000.
Let's work that out. 0.80 is 0, plus 0.15 $100,000 is $15,000, plus 0.05 $500,000 is $25,000.
So 0 plus $15,000 plus $25,000.
Gives us a total provision needed of $40,000. This amount represents the most accurate statistical expectation of the total warranty costs across all the cars sold in that period.
That distinction is so important for exams, isn't it? Single event, most likely outcome, large population, expected value.
Absolutely nail that difference.
Okay, now let's add another layer of complexity, time. What happens if the payment isn't due for ages?
Good point. That brings us to C, the impact of time, discounting. If the obligation isn't going to be settled for a significant period, and IAS 37 uses the term materially different for the time value of money effect, then you can't just provision the full future amount today. You have to discount it back to its present value.
Why? Because a pound or dollar paid in, say, 5 years isn't worth the same as a pound or dollar today, right?
Exactly. It's fundamental to faithful representation. If you recognize the full future amount today, you'd actually be overstating the liability's current value. The provision needs to reflect the amount you'd rationally need today to settle or transfer that obligation.
Let's use that HRCO legal claim example to see how the discounting works, and importantly, what happens after the initial recognition. HRCO expects to pay $495,000, but not for another 6 months. The discount rate is 10% per year.
Okay, first step is to figure out the provision amount to recognize right now, let's say at the year end, 31st December 20X1. The payment of $495,000 is 6 months away. We need to discount that amount back to today's value using the 10% annual rate. Now, the calculation itself, applying a 6-month discount factor at 10% per annum to $495,000. The example stated this leads to an initial provision of $450,000. Let's assume that calculation is correct for now. This $450,000 is the liability recorded on the balance sheet today.
Okay, $450,000 on day one, but we know they have to pay $495,000 in 6 months. What happens to that $450,000 liability over those 6 months?
It has to grow. It accretes is the technical term. It needs to increase over the 6 months to reach the full settlement amount of $495,000. The difference between the start, $450K, and the end, $495K, is $45,000. That increase represents the time value of money, the interest cost of the liability sitting there for 6 months. It's the unwinding of the discount.
And that unwinding, that $45,000 increase, it's not like we adjust the original expense that caused the provision, is it?
No, absolutely not. That unwinding of the discount is recognized separately as a finance cost or interest expense in the statement of profit or loss over that 6-month period.
Finance cost.
Yes. Now, looking closely at the example figures, an initial $450,000 growing by interest over 6 months at 10% pay, well, 10% of $450K for half a year is $22,500. Adding that only gets us to $472,500, not the full $495,000.
Yeah, the numbers don't seem to quite reconcile to reach $495K with just $22.05K interest. Maybe the initial PV calculation was different, or there was rounding, or the source example simplified something.
Could be. But the principle is what matters for your understanding. You start with the present value. That liability then increases over time until it reaches the future value, the settlement amount.
Right.
And that increase, period by period, is charged to the P&L as a finance cost. If the total increase needed was indeed $45,000 over 6 months, then $45,000 would be the total finance cost recognized in that period.
Okay, got it. Initial recognition at PV, subsequent increase is finance cost and P&L. That clarity on the type of expense finance cost versus whatever caused the initial obligation is key for presentation.
Absolutely. It separates the cost of the event itself from the cost of financing that obligation over time.
Right, last measurement scenario then. What about provisions that are directly linked to buying or building a physical asset?
Yes, this is D provisions connected to assets, PPE. Think decommissioning costs, site restoration. Big environmental cleanups often fall here. When a company builds something like a mine, an oil rig, a nuclear plant, something long-lasting, and they have a legal or even a constructive obligation to dismantle it and clean up the site at the end of its life, well, that future cleanup cost is actually considered part of the cost of getting the asset ready for use today.
So it's capitalized, like added to the cost of the asset itself. That aligns with the matching principle, doesn't it? Matching the cost with the period of benefit.
Exactly. You wouldn't have the benefit of the asset without eventually incurring the cleanup costs. So you calculate the present value of that estimated future cleanup cost, and you add it to the initial cost of the property, plant, and equipment, PPE, on the balance sheet. It's not just expense straight away.
Okay, let's use the oil rig example. Say the rig itself costs $100 million to build, and they estimate the decommissioning in 10 years will cost $10 million. The discount rate is 10%.
First, find the present value of that $10 million payment due in 10 years, using a 10% discount rate over 10 years. The example suggests the PV is around $3.86 million.
So how does that hit the accounts on day one?
On day one, the PPA asset isn't recorded at just $100 million. It's recorded at the construction cost, 100 meters, plus this capitalized provision, $3.86. So the asset goes on the balance sheet at $103.86 million.
Okay.
This total cost, $103.86, is then depreciated over the rig's useful life, let's say 10 years. At the same time you recognize the asset, you also recognize the other side of the entry, a liability, the provision for decommissioning of $3.86 million.
And like the legal case, that $3.86 million liability doesn't just sit there unchanged for 10 years, does it?
No, absolutely not. Just like before, it needs to grow to the full $10 million needed in 10 years. So each year, the provision liability increases due to the unwinding of the discount.
And that annual increase is?
A finance cost, charged to the statement of profit or loss each year. Over the 10 years, the sum of all those annual finance costs will bring the liability up from the initial $3.86 million to the target $10 million needed for the cleanup.
So it's a double hit in the P&L each year.
Yep.
Depreciation on the inflated asset cost and the finance cost from unwinding the discount on the provision.
That's the correct treatment. It fully reflects both the use of the asset and the financing cost of the future obligation. Hashtag tag 3. Specific provision scenarios. Exam favorites.
Okay, we've got the basic rules down, 3 criteria for recognition, and how to measure using most likely outcome, expected value, or discounting. Now let's get into the trickier areas. The scenarios that examiners love because they test that deeper understanding, especially around the unavoidable obligation idea.
Yes, these 3 often look like they should be provisions, but IAS 37 has very specific rules that can sometimes override that initial feeling. They really test your grasp of when an obligation becomes truly unavoidable.
Let's start with something that seems logical but is a definite no-no.
Yeah.
A, future operating losses.
Right. The rule here couldn't be clearer. You cannot make a provision for anticipated future losses. Simple as that. If your management team sits down, does the budget, and forecasts that, say, the European division is going to lose $5 million next year, they absolutely cannot create a $5 million provision for that expected loss today.
But why not? It feels prudent, doesn't it? If you know a loss is probably coming, why not recognize it now?
It fails that first fundamental test, present obligation from a past event. An expected future loss isn't a liability caused by something that's already happened. It's a prediction based on current circumstances and future expectations. Crucially, management still has options. They could potentially avoid that loss. They could decide to sell the division, drastically change its strategy, maybe even shut it down before the losses actually happen. Until some past event irrevocably locks them into those costs, there's no present obligation.
So things like losing market share or maybe forecasting higher raw material costs next year, those don't create a provision.
Correct. Those kinds of business worries might trigger looking at asset impairment under IAS 36 to see if assets related to that division are overvalued. But you don't create a provision under IAS 37 just because you expect tough times ahead. You can't provision for bad luck or potential future poor performance.
Okay, no provisions for future losses in general. But there is an exception if those losses are basically trapped inside a specific type of contract, right?
Exactly. The only way future losses effectively get recognized now is if they're embedded in what IAS 37 calls an onerous contract.
What?
Let's dive into B, onerous contract.
What makes a contract onerous, too?
An onerous contract is one where the unavoidable costs of actually fulfilling your side of the deal are higher than the economic benefits you expect to get back from it. Think of a non-cancelable lease on a factory building that you've now completely emptied and have no use for, but you still have to pay the rent for 3 more years. That lease has become onerous.
So the moment the contract flips into being loss-making, and you can't just walk away from it, that becomes the obligating event. Because signing the contract in the past now inevitably leads to a future outflow.
Precisely. The obligation crystallizes the moment it becomes onerous. And you have to recognize a provision immediately. Now, measuring this one is tricky. The provision amount is the lower of 2 figures.
Lower
of. 1, the cost of actually sticking with the contract and seeing it through, which will be the total net loss you expect to make over the remaining term. Or 2, the cost of getting out of the contract, like paying a cancellation penalty or compensation.
Right. So the company has to figure out the cheapest way to deal with this bad contract, and that's the amount of the provision. Minimize the damage.
Exactly. Let's use the Diva cloth contract example. Diva signed a deal to buy 900 meters of special cloth every month at $7 per meter. But the market for the dresses they make from this cloth has tanked. Now, using this cloth means they make an unavoidable operating loss of $500 every month. The contract still has 2 months left to run.
Okay, loss-making. Can they cancel it?
They can cancel, but there's a penalty. The penalty is $700 for each remaining month, so $700 times 2 months.
Right, so 2 options. Option 1, keep buying the cloth and making the loss-making dresses for 2 more months.
The cost of that option, assuming we ignore discounting for this short period, is the operating loss per month times the number of months. So $500 loss month, 2 months equal $1,000 total loss.
Okay. Option 2, cancel the contract immediately and pay the penalty.
The cost of that option is the penalty per month times the number of months. $700 penalty month, 2 months, $1,400 total penalty.
So the provision has to be the lower of the $1,000 continuing and $1,400 canceling.
Correct. Therefore, Diva must recognize a provision for $1,000. Even though they could pay $1,400 to get out, the cheaper unavoidable outcome is to fulfill the contract and absorb the $1,000 loss. That becomes the best estimate of the liability. If the penalty had been, say, only $400 per month, $800 total, Then that would have been lower, and the provision would have been $800.
It really highlights that need for judgment, calculating the least costly, unavoidable outflow.
It does. Now, the third tricky area, large-scale internal shakeups. See restructuring costs. This is where that line between just an internal management plan and a true constructive obligation gets tested all the time.
What counts as restructuring here?
Things like selling off or closing down a whole line of business, maybe shutting factories, relocating major operations from one country to another, or significant reorganizations of the management structure. These often involve huge costs, redundancy payouts, lease terminations, asset write-offs.
But IAS 37 is quite strict about when you can actually provision for these costs, isn't it?
Yeah.
Because management could just change their mind.
Exactly. Until certain specific steps are taken, it's often still just a plan, not an unavoidable obligation. So IAS 37 sets two conditions that both must be met before you can recognize a restructuring provision.
Okay, what are the two hurdles?
First, there has to be a detailed, formal plan. This plan needs to be specific which parts of the business are affected, which locations, roughly how many employees, when it's going to happen, and an estimate of the costs. Just vaguely saying we need to downsize isn't enough.
Needs detail. And the second condition?
Second, and this is often the crucial trigger, the main features of the plan must have been announced to those who will be affected by it, or the company must have started to implement the plan.
Why is the announcement or starting implementation so important?
Because that's what creates the constructive obligation. Once you formally tell your employees they're being made redundant, or tell your suppliers you're closing the factory they supply, or tell customers you're discontinuing a product line, you've raised a valid expectation that you will follow through. At that point, it becomes very difficult, realistically and reputationally, for the company to back out. The announcement effectively locks them into the restructuring and its associated costs, like redundancy payments.
Let's use the Polyascanas factory closure example. Scenario A. The board decides internally to close the factory, but by the year-end reporting date, they haven't told anyone, employees, suppliers, nobody.
In scenario A, no provision. It's still just an internal management intention. There's no past obligating event, like an announcement, that has created an unavoidable obligation yet.
Okay. Scenario B. Same decision, but this time, before the year end, they've agreed on a detailed closure plan, and they've sent out formal letters to the workforce about redundancies and to key suppliers about terminating contracts.
Now it's different. The detailed plan exists, condition 1 met. The communication to affected parties has happened, condition 2 met. That communication is the obligating event. It creates the constructive obligation. The outflow for redundancy costs, etc., is now probable, and the costs are presumably reliably estimable from the plan. So in scenario B, a provision is appropriate.
Right. Now, for the bit examiners love to catch people out on. Even when a provision is appropriate, what specific costs are not allowed to be included in that restructuring provision?
This is absolutely vital. The provision must only include costs that are C, 1, directly and necessarily caused by the restructuring itself, and 2, are not associated with the ongoing, continuing activities of the business.
Okay, so what's in?
Definitely in. Employee termination benefits, redundancy pay, costs of terminating contracts that have become onerous because of the restructuring, like a factory lease you no longer need, maybe costs of dismantling plant or equipment specifically due to the closure.
And what's explicitly out?
Out are costs related to the future ongoing business. Things like retraining or relocating staff who are staying with the company but moving to different roles or locations. Marketing costs for new products launched by the remaining parts of the business. Investing in new IT systems for the continuing operations. Basically, any cost associated with running the business after the restructuring.
Why exclude retraining costs, for instance? If the restructuring forces people into new roles, isn't that a direct consequence?
It's a consequence, yes, but it relates to the future conduct of the business. Retraining staff is about enabling the continuing operations to function. A restructuring provision is strictly for the costs associated with stopping or scaling back certain activities, not for investing in the future shape of the business. Examiners love putting those continuing activity costs into scenarios, and you have to be sharp enough to exclude them from your provision calculation. Okay, so we've covered provisions: present obligation, probable outflow, reliable estimate. All three met, recognize. But what if an item doesn't quite meet that high bar? What if the outflow isn't probable? Or maybe you just can't measure it reliably? That's when we move out of provision land and into the Let's call it the contingency zone.
Right. This is where we decide between just disclosing something in the notes versus recognizing it on the balance sheet. It's a crucial distinction.
Absolutely. And it hinges on probability and measurement reliability.
Let's start with the liability side of this zone. Things that might cost us money but aren't probable enough to be a provision. A. Contingent liabilities.
Exactly. A contingent liability is defined in IAS 37 as basically one of three things. It could be a possible obligation, where maybe we're not even sure if an obligation exists yet, depending on some future event. Or it could be a definite present obligation, but where the outflow of resources is not probable, meaning 50% likely or less. Or, thirdly, it could be a present obligation that's probably going to result in an outflow, but we hit that rare problem we mentioned earlier. The amount cannot be measured reliably.
So the common thread for most contingent liabilities we see in practice is that the likelihood of paying out is merely possible, not probable.
That's usually the key differentiator. Possible here means the chance of an outflow is more than remote, so it's not insignificant. It's a risk worth noting, but it's less than probable. It falls in that probability band between, say, 5% and 50%.
And when we land in that possible zone for a liability, what's the accounting treatment?
The standard is very clear. Disclose by note only. You do not recognize anything on the balance sheet.
But you absolutely must disclose it, right? You can't just ignore it because it's not a provision.
Correct. That note disclosure is vital for giving users the full picture. Faithful representation demands it. The note needs to explain what the potential obligation is about, what the main uncertainties are, like timing or the exact amount, and, if you can, give an estimate of the potential financial impact, or at least the range. This flags the risk to investors and creditors without cluttering the balance sheet with something that's not yet more likely than not.
Let's make this concrete with the Justina food poisoning lawsuit example. Justina's business is being sued for $300,000. Her lawyer has looked at the case and advises there's a 42% chance she will lose.
Okay, 42% chance of losing means a 58% chance of winning. Since the probability of the outflow, losing the case, is 42%, that is not probable. It's less than the greater than 50% threshold.
So even though 42% feels quite high,
It doesn't matter how high it feels. It's not over 50%. Therefore, Justina must not recognize a provision for $300,000. She must treat this lawsuit as a contingent liability. That means describing the situation, the lawsuit, the amount claimed, the uncertainty in the notes to her financial statements.
and this is precisely where students often slip up, isn't it? They see 42% or 45% and think, oh, that's pretty likely, must be a provision.
It's the classic mistake. You have to rigidly apply that more likely than not definition for recognizing liabilities. Below that line is disclosure territory. Now, if the lawyer had said the chance of losing was, say, only 3%, then it would likely be considered remote, and in that case, Justina wouldn't even need to disclose it. No action needed for remote possibilities.
Okay, so that's contingent liabilities, possible outflows get disclosed. Now, what about the other side of the coin? Potential inflows of cash or resources. B, contingent assets.
Right, contingent assets. And the first thing to hammer home here is that they are treated completely differently from contingent liabilities. There's a deliberate asymmetry, and it's all down to a core accounting principle: prudence.
Prudence, meaning be cautious, don't count your chickens before they hatch.
Exactly. Prudence, as defined in the conceptual framework, means exercising caution when making judgments under uncertainty. Specifically, it means assets and income should not be overstated, and liabilities and expenses should not be understated. So when it comes to potential gains or assets, we need much higher certainty before we recognize them.
So first, what exactly is a contingent asset?
It's defined as a possible asset that arises from past events, but its existence and value will only be confirmed by some uncertain future event happening or not happening events that are not really under the company's control. Think about claiming on an insurance policy after a fire, or maybe pursuing a legal case where you're the plaintiff hoping to win damages.
Okay, so let's apply the probability test. If the inflow from this contingent asset, say, the insurance payout is assessed as being probable, more than 50% likely, can we recognize the asset then?
Absolutely not. And this is the other big mistake students make. They try to apply the same probable threshold to assets as they do to liabilities. It doesn't work that way.
So what do you do if the inflow is probable?
If the inflow is only probable, so greater than 50% but not virtually certain, you must disclose by note only, just like a contingent liability. You explain the situation in the notes, but you do not put the asset on the balance sheet. Prudence stops you from recognizing potential income until it's almost in the bag.
Okay, so probable only gets you disclosure for an asset. What level of certainty do you need to actually recognize it?
You need the inflow to be virtually certain. That's the term IAS 37 uses.
Virtually certain. That sounds like a much higher bar than probable. Is there a percentage guideline?
There's no official percentage in the standard, but in practice, people generally interpret virtually certain as meaning something like 90% or 95% likelihood, or even higher. It means there's almost no doubt the cash is coming in. At that point, it's not really a contingency anymore. It meets the basic definition of an asset because the inflow is practically assured.
The insurance claim example highlights this well. Say inventory was stolen. The company files a claim. The insurance company investigates and tells them that reimbursement is highly likely. Let's say the company assesses that as 75% probable.
Okay, 75% probable. That's probable, but it's not virtually certain. So at this point, the company cannot recognize an insurance receivable asset on its balance sheet. It must only disclose the situation, the claim, the expected amount, the fact it's probable in the notes as a contingent asset.
And when can they recognize it?
Only when the uncertainty is removed. For example, when the insurance company formally agrees in writing to pay a specific amount, sends the settlement documents, maybe even confirms the payment date. At that point, the receipt of cash becomes virtually certain, and then the company can recognize the receivable asset.
What if the likelihood was lower? Say, only possible or even remote?
If the inflow is only possible or remote, you simply ignore it. No disclosure, no recognition.
Wow, the contrast is stark. Liabilities. Recognize at 50% probable. Assets. Only disclose at 50% probable and only recognize at maybe 95% plus. Virtually certain.
That asymmetry is fundamental. Prudence dictates we recognize expected losses sooner, probable, but expected gains later, virtually certain. It prevents companies from booking profits prematurely based on uncertain future events. #Tag5, review and final exam strategy.
Right, we've covered a lot of ground there, from definite provisions needing recognition, through the measurement rules, the specific tricky scenarios like onerous contracts and restructuring, and finally into the contingency zone of disclosure for liabilities and assets. Let's try and boil this down into a clear decision process for listeners, especially those facing exams.
Definitely. Having a systematic thought process is key for tackling any IAS 37 question under pressure. It helps ensure you apply that professional judgment correctly.
Okay, let's call it the provision decision matrix. Step 1.
Step 1. Is there a present obligation resulting from a past event? This is your first gate. Ask yourself, is the company locked in now because of something that's already happened? If the answer is no, maybe it relates to a future event or management can still avoid it, then you generally ignore it straight away. Unless it's an onerous contract. Remember, if a contract becomes onerous, the signing of the contract in the past combined with the current loss-making situation creates the present unavoidable obligation. So if it's an onerous contract, you proceed to step 2, even if other future losses are ignored.
Okay, so if yes to present obligation, or it's an onerous contract, we move to step 2. This is where liabilities and assets diverge, right?
Correct. Step 2 for potential liabilities. Is an outflow of resources probable? Remember, probable means greater than 50% likely.
If yes, it's probable.
If yes, then you have a provision. Assuming you can also estimate the amount reliably, step 2B really, you recognize the provision on the statement of financial position.
And if no, the outflow is not probable, maybe it's only possible.
If the likelihood is just possible, somewhere between remote and probable, so 5% to 50%-ish, then you have a contingent liability. The rule is disclose it in the notes. If it's remote, you ignore it.
Okay, that's liabilities sorted by probability. Now, step 3, which is really step 2 for potential assets, the test is different here.
Yes. Step 3 for potential assets. Is the inflow of economic benefits virtually certain? Not just probable, but virtually certain. Think 90-95% or more.
If yes, it's virtually certain.
If yes, the high bar for asset recognition is met. You recognize the asset on the statement of financial position. It's no longer contingent.
And if no, what if the asset inflow is only probable, say 70% likely?
If the inflow is only probable but not virtually certain, then you have a contingent asset.
Okay.
The rule, driven by prudence, is disclose it in the notes only. And again, if the inflow is only possible or remote, you ignore it.
That matrix really clarifies the asymmetric treatment.
Yeah.
Understanding those different probability thresholds for liabilities versus assets is absolutely core to getting IAS 37 right.
It really is.
Now, let's quickly recap those common pitfalls that TRAPS examiners said to see if you've truly understood the nuances.
Okay, mistake 1. Misinterpreting probability. We've said it before, but it bears repeating. Do not confuse possible with probable. If an exam scenario gives you a 40% or 45% chance of losing a lawsuit, you disclose you do not recognize a provision. Stick rigidly to that greater than 50% rule for liability recognition.
Mistake 2, forgetting disclosure. This happens a lot. Students correctly figure out, okay, this isn't a provision because it's not probable, but then they stop. They forget the crucial second step. If it's a material possible obligation, a contingent liability, you must provide disclosure in the notes. That disclosure often carries significant marks.
Mistake 3, treating assets and liabilities symmetrically. Applying the probable test to recognize a contingent asset is a fundamental error. It shows you haven't grasped prudence. Remember the much higher, virtually certain standard for booking assets.
Mistake 4, provisioning for future losses. Unless it's tied to an onerous contract, you simply cannot make a provision today for general operating losses you expect to incur next year. It fails the past event test because management can, in theory, still act to avoid those losses.
And maybe one more point, really scrutinize those constructive obligations, especially in restructuring scenarios. Ask yourself, has the company truly committed? Is the announcement specific enough? Have they started implementing? Has a valid expectation really been created? Auditors spend ages verifying this. Your exam judgment needs to reflect that same level of scrutiny.
Okay, fantastic. This deep dive into IAS 37 should hopefully give you, our listeners, that solid framework. The concepts, the rules, the examples, everything you need to apply professional judgment and navigate those tricky scenarios. You should now feel much more confident in making that key decision. Recognize, disclose, or ignore.
Exactly. And remember, good financial reporting isn't just about following rules. It's about communicating clearly. Understanding IAS 37 helps ensure you report a company's obligations and risks faithfully, giving users the information they need without misleading them with premature recognition of uncertain items.
All right, let's wrap up with a final thought, something to connect this accounting standard to the wider world. Think about climate change. We're seeing more and more legislation targeting environmental damage, carbon emissions, cleanup responsibilities. Now imagine a new law is passed. It says heavy industries must pay for the future cleanup costs related to their past emissions, things that happened maybe decades ago before this law existed.
Okay.
The provocative question is, when does that future cleanup cost become a provision that needs recognizing today? Is it the moment the law is enacted, creating a legal obligation, even if the specific rules and timings are still hazy? Or does the obligation only crystallize later, perhaps when the company, forced by the law, makes a very public, detailed announcement about a specific remediation plan, creating that constructive obligation and valid expectation?
That's a great question, because the answer determines the exact year, maybe even the quarter, that potentially billions of dollars could hit companies' balance sheets as provisions. Nailing that timing judgment, distinguishing between the legal trigger and maybe a later constructive trigger, that's the sharp end of applying IAS 37 in the real world.
And that's the kind of judgment this standard demands.
It is indeed.
Well, this deep dive has been part of our ongoing series looking into IFRS and financial reporting standards. We really hope it gives you the clarity and confidence you need, whether for exams or just understanding accounts better. We'll be tackling other key standards in future sessions.
Definitely check out the study resources linked below for more support.
And please do subscribe if you want more of these kinds of expert breakdowns, cutting through the complexity to get straight to what you need to know. Thanks for joining us on the deep dive.